Good afternoon, good evening, even good morning to some of you. Welcome. I am Dr. Richard Smith, Chairman and CEO of the Foundation for the Study of Cycles, and we are back for day 4 of this unbelievable Financial Cycles Summit. It's been absolutely spectacular. We could not be happier with the quality of the speakers we've been able to bring you, and today is no exception. In fact, we've saved some of the best for last. Today with me is my good friend and longtime mentor, in fact, one of my first mentors in this business, Jake Bernstein. Jake, welcome.
Thank you, Richard. It's a pleasure and an honor to be here among such erudite and quality company and given the opportunity to make a presentation. I appreciate it. Well,
I'm very excited about your presentation, and I know you've got a lot to say, and I don't want to keep everyone too long, but I did want to mention I've got one of my favorite books here. and Jake, it's not even signed. Somehow we have to remedy that, but
send it to me, Richard, and I'll take care of that for you.
It says in the beginning, this book is dedicated to traders and investors everywhere who have, through their struggles, come to understand that success in the markets is more dependent upon their own behavior and personal psychology than upon any system, method, program, computer, or advisor.
That was well written.
That was well written. I thought that was worth sharing with everybody. So Jake Bernstein, of course, is the author of, I don't know, what is it, close to 50 books now?
45.
45 books. But The Investor's Quotient, The Investor's IQ is one of the most important books in my library. Of course, MBH Commodity Advisors. Jake, you've been in this business pretty much since I was born.
Thank you. Thank you for that, Richard.
So great to have you today. I know you've got a lot, and you've even asked me to kind of keep the questions until the end, which is pretty unusual for you because you like a lot of interaction, but I know you usually go a couple hours instead of just 1 hour.
So exactly.
Sure you're packing it in. But Jake, you've been a supporter of the foundation. I've even got some photographs of you from back in the 70s, probably. I think there might have been some bell bottoms.
Promise not to blackmail me.
I won't share them online, but you spoke at some of the foundation events back in the 70s and 80s, I believe. Is that right?
I sure did, at the Greenbrier in West Virginia.
Well, I hope we'll get to do that again sometime in the not too distant future.
It'd be fun.
All right. Well, the floor is yours, Jake. I will bow out and try to keep my mouth shut until we get to the end of your presentation. Thanks so much. Right. Take it away.
I'm going to start my screen sharing, and you should be seeing my screen now.
We got it.
Okay, let me go full screen on it. Here we go. And there we are.
All right.
Ready to go?
You got it.
Thank you.
Take it away.
Thank you. So I have a lot to say today. I have a little less than 1 hour in which to say it. Most important thing I will tell you is this. I'm here today because I enjoy being here. I'm not here to make money. I'm not here to get money. I'm here for one reason, that is to promote the excellent work that the Foundation for the Study of Cycles is doing under the brilliant leadership of Richard Smith. And had it not been for Richard, the Foundation would still be underground, not functioning well as it did for a number of years. But it's a new ball game, and I appreciate everyone who's associated with the Foundation, who's working very hard to bring everyone education in the important work that the Foundation is doing. So let me go to the first slide, the necessary usual boilerplate disclaimer. Edward R. Dewey, the so-called father of cycles, stated that cycles are the mysterious forces that trigger events. So you should be seeing that slide right now. Slides are changing and you see that, correct?
Yes.
Good. It was quite by accident that I stumbled upon the work of the foundation in the early 1970s. What I want to do today is to go through some indications, some history of how the foundation changed my life, not only to the extent of me enjoying doing what I'm doing and learning how to do what I do, not only to the extent of making me wealthy, but also to the extent of giving me a new view on what trading and investing are all about. If you have some time and you get the copy of this presentation, you'll learn a little bit about me. Been trading since 1967, written over 44 books. I'm a real trader, which means I'm not a theoretical trader. I trade what I teach and I teach what I trade, and I trade every day. In fact, just before the meeting today, I was closing out some trades. My work is purely technical. I do not use fundamentals. So my work is based on computer testing and development of all my strategies. And I have to say that one of my best strategies, seasonality, was actually programmed by Richard many years ago, and we worked together on seasonaltrader.com for a long time. So everything I do is back tested on computer. I've taught thousands of traders all over the world how to trade. I've been at 830 seminars and webinars all over the world, been on Wall Street Week, CNBC, FNN, CNN. I'm not a broker. I'm just an educator. I manage my own accounts. I trade my own money, my family money, and my clients, individual traders, top newsletter writers, and many of the biggest hedge funds in the world buy research from me. We'll get into that some other time. The world is so impersonal these days that when you're talking to people by Zoom or computer, you have no idea where they are. Excuse me. I'd like to make it a little more personal and show you where I am today. So right now today, sitting at my desk here in the mountains, Santa Cruz Mountains of California, just south of San Francisco, and I am just right over here, right in the middle of the Redwood Forest. Excuse me, mostly living off the grid, and I'm glad I have an internet connection. In every webinar that I've done, I've taken questions during and at the end of the session. Today's going to be different. I'm not going to take any questions. You're welcome to email me questions after the webinar is over, and of course, Richard, welcome to ask me questions after it's over as well. There's a reason for that. I'm not going to take any questions today if you will indulge me with a little bit of patience. Consider the average trader who goes to the internet and says, I would like to learn how to trade. So they type in, teach me day trading or teach me how to trade. And what they get is 80 million hits. Not an exaggeration, 80 million hits. The vast majorities are advertising for all of these trading systems. Here's the thing. The good news about the internet is you can get a lot of information. The bad news is you can get a lot of information, too much information, and terrible information. Most of the information that you will get from people on the internet who are willing to sell you their trading strategies, their trading systems, their trading coaching for thousands of dollars, most of that information is worthless, useless, garbage. It's been curve fitted. It hasn't been tested. It's phony. They hide behind the CFTC disclaimer saying that hypothetical results do not guarantee the future. And you will pay for that information dearly, thousands of dollars. Why do that when you can come here to the foundation and for 99 bucks a year, get solid, valuable information from veteran traders, people who've been doing this for a long time, who really know what they're doing. It never ceases to amaze me. So the reason I'm not going to take any questions today is this. I don't want to answer your questions. Number one, I don't have the time because I have a lot of important information to show you. And number two, I want you to have more questions. I want you to come back and ask those questions. I want you to become a member. It's super important, the work that we're doing. And we don't stand to profit from any of it. We're a class, was it 503C or 501C not-for-profit organization. We don't make any money off of this, and we don't want to. We give our time and energy solely for the purpose of helping people learn these methodologies. So what I want you to do is indulge me a little bit further. I want to tell you about how my fantastic journey into cycles began so many years ago and brought me to this point. So the bottom line is this. This place that you see on your screen now is where I was born. A place called St. Ottilien, Oberbayern, Bavaria, Germany. In fact, I was born in this room where the red arrow is. Why is that important? I will tell you about that momentarily. But suffice it to say that when I went to school, I graduated from the University of Illinois with a degree in clinical and experimental psychology and started my first job in the summer of 1968 at a mental institution dealing with regressed psychotic patients. Some people say I still do the same kind of work today, but I get paid better. But the bottom line is this. My first day at the hospital in the summer of 1968, imagine, the hospital had 5,000 patients. It covered about 10 city square blocks. Used to be a prison during the Civil War. And the first day on the job, as I was walking to my unit, a gentleman, very tall gentleman, came running out of the unit, completely naked, jumped onto a car that had 6 nuns in it, and began to terrorize those nuns. And I said to myself, do I really want to do this kind of work? Is this what I signed up for? Fortunately, a few nights later, as I was working, I saw a Wall Street Journal. I had no education in finance. I came from a very poor family. My parents were in concentration camp, which is how I came to be born at the monastery. And I said to myself, I'm not interested in doing this kind of work, even though I was trained to do it. I want to do something else. I had never seen a Wall Street Journal before. And there in the Wall Street Journal was an ad. It had a picture of a rocket ship going to the moon. And in the rocket ship was a dozen eggs. And in the moon was a man's face named Maury Schneider. And it said, will eggs hit the moon this year? It was intriguing. There was a coupon. I filled out the coupon and sent it in. Lo and behold, I get a book telling me that egg futures were going to be very big. Great investment. And of course, nothing is free because the broker started calling me, telling me, Jake, send me $1,000. I'll make you rich. Rich doing what? He said, trading eggs. I said, how do you trade eggs? He said, you don't need to know how to trade eggs. Just send me $1,000. Now remember, in 1968, $1,000 was the equivalent of $16,000 today or more. You could buy a brand new Volkswagen for $1,400. Of course, I didn't have the money. Dan kept on calling me. We talked on the phone for about 1.5 years, 2 years. Finally, he said, look, you've got to get that money. You work at a hospital, don't you? I said, yes. He said, find some doctors who are not good at English, borrow the money, tell them that in a year you'll give them back their money double. So I went to the various doctors and borrowed some money and sent Dan $1,500. He began trading for me. I had no idea what he was doing. I started getting pieces of paper in the mail. We have bought for your account and risk today 1 November shell eggs. A few days later, I get another piece of paper. He sold the eggs. He made $250. He kept 70. I got the rest. I liked what was happening. I kept getting these pieces of paper in the mail every couple of days, and he was making money. Pretty soon, the $1,500 that I sent him was $2,000, $3,000, $4,000, $5,000. He called me up and he said, Jake, I'm sending you some money. Pay off the doctors. We'll trade with the rest of it. I said, what do you mean trade? He said, don't worry. You don't need to know what I'm doing. Just let me keep on doing it. He kept on doing it. I was going to graduate school at the time, living at home. One day, my father, who was from the old country and barely spoke English, opened one of the envelopes that came to me. And inside it said that my account was worth $7,000. $7,000 was a lot of money to my father, who never earned more than $6,000 in an entire year of work. He said, "Jake, how you make this money?" I said, "Dad, I'm trading futures." He said, "Futures? What is futures? How do you explain futures to a man who never had a credit card?" I said, "Well, Dad, listen, I buy and sell things that don't exist with money I don't have." Well, he didn't understand that in the slightest. He said, "You take money, put in bank." Pretty soon the money was worth a lot more. It was in the $20,000 and $30,000 range. I said to myself, I need to learn how to do this. Where's the best place to learn? Go to the library. I studied everything I could get, but still, I wasn't getting any clear answers. I said to Dan, the broker, "How do you do this?" He said, "Okay, I'm going to tell you how to do this, but you need to promise never to tell anybody else." I said, "Fine." He said, "You will notice we only trade eggs." "Where do eggs come from?" I said, "Chickens." He said, "Where do chickens come from?" I said, "The farm." He said, "Do you know what affects the production of eggs?" I said, "No." He said, "Happy chickens. When chickens get happy, they lay more eggs. When chickens get unhappy, they lay less eggs." I said, "What makes chickens happy?" He said, "If the temperature is between 70 and 78 degrees, chickens are happy. If it gets any lower than 70 or any higher than 80, they get very unhappy and they lay less eggs." I said, "So what do you do to make money with this information?" He says, "Look, when the temperature goes over 80 degrees, egg production is very low. If demand stays the same and egg production goes down, prices go up." I said, "Okay, so how do we make money?" He says, "We have a weatherman. The weatherman tells us when it's going to get hot in the egg producing areas. We buy eggs. 2 days later, it gets hot. The chickens get unhappy. They lay fewer eggs. We sell our futures and make money." I said, "That is absolutely brilliant." He says, "Oh, you haven't heard the rest of it yet. Just wait." He said, "You know what happens when it gets to be 85 to 90 degrees? I said, "The chickens must get very unhappy." He says, "Oh, they get so unhappy, they lay hardly any eggs." I said, "That's fabulous." He says, "Do you know what happens after the temperature gets to be 90 degrees or higher?" I said, "No." He says, "The chickens die." I said, "That's absolutely horrible." He said, "No, that's good." I said, "How could that be good?" He said, "Dead chickens don't lay eggs and they never come back. Not only that, there's another thing about chickens. Have you ever heard of something called Newcastle disease?" I said, "No." "What is it?" He said, "It's chicken cancer and it comes back every 7 years. It's a cycle." He says, "We're dealing with a seasonal and a cycle. Go back and look at some graphs. See what happens to egg prices in May, June, July, and August, and see what happens to chicken and egg prices every 7 years." I looked at some charts. I couldn't believe it. It was fabulous. I said, "So I want to do this." He said, No, I'm doing it for you." He says, "You go do something else." I said, "Like what?" He said, "Go to the library, get a book on trading, learn how to look at charts." I go to the library, look at charts. I see lines, trend lines, support, resistance, all of the things that people are still using today. I make a chart and I notice that pork bellies are going up and down, and they always come down to the trend line and go right back up again. So I talked to Dan about it, the broker, and I said, "What about that?" He says, "That doesn't work." He says, "The only thing that works are patterns, and that's not a good pattern, and there's no cycle there. And besides that, pork bellies are frozen. They're already dead. Don't trade anything that can't die." Okay. I studied some more. I realized that I could do this myself, or at least I thought I could do it myself. I told Dan, "I'm taking over." He said, "You're not taking over." I said, "Yes, I am." I said, "It's my account." He said, "You take it over, you're going to lose everything." I took over the account, and in 7 days, I lost everything that Dan had made in 3 years. So I returned to the library, and here comes the big discovery. I found a magazine called Cycles. It was a magazine that had things in there that I've never seen before. I saw pictures. I saw graphs. I saw cycles in tree rings, cycles in weather, cycles in eggs, cycles in cattle, cycles in the stock market. I couldn't believe what I saw. I began to study everything that I could do, and the process that was hiding in plain sight was cycles. It was an amazing discovery, and I thought I found the Holy Grail. So after that, I went back to the place where I was born. The reason I went back there was because I had studied and I had started writing some articles, and I was invited to give a speech at a conference in Frankfurt. So I went to the conference and I decided, since I'm already in Frankfurt, Germany, I might as well go and visit the place where I was born. I went back to the place where I was born, right here on the screen, knocked on the door. A very old monk came to the door, literally had a beard down to his knees, and said in German, "Can I help you?" I said, "Yes, I was born here." He was flabbergasted. He invited me and we talked. He said, "Who are your parents?" I told him. "Do you remember them?" He showed me my name in a book. I said, "You have my name in a book?" He says, "Yes. Here's your name, the date you were born, the time, the nurse that delivered you, the midwife that delivered you." I said, "How do you have this information?" He said, "We're Germans. We keep good records." We talked and talked for hours on end. And then he asked me what I did, and I explained it to him. And then he said something to me this. He said, "Je mehr Sie Dinge ändern, desto mehr bleiben sie gleich." Or in French, plus ça change, plus la même chose. The more things change, the more they stay the same. We talked about cycles. We talked about birth and death. We talked about the Bible, the 7 years, lean years, the 7 rich years, and so forth. And he encouraged me to go back and do the work that I was doing. So what I'd like to do today is to show you a few of the cycles that I look at. But most of all, I want to show you how I do what I do and bring some knowledge to you that you may already have if you've been familiar with my work. So let me show you something. And I want to stress, cycles are just the beginning step. As you've heard from the speakers in the last couple of days, none of them use cycles exclusively because cycles, in my view, are a framework. There must be a driver. Something else has to happen. But let me show you some amazing things that occurred to me in my studies. We have here a chart of euro-dollar interest rate futures, not to be confused with euro currency. The euro-dollar is a short-term interest rate future, so that when interest rates go down, euro-dollar interest rate futures go up. When interest rates go up, euro-dollar futures go down. But here's the thing. And the reason they're called euro-dollar futures is because they're US dollars kept in Europe and lent out at a lower rate than the T-bill. So it's essentially similar to a 91-day T-bill. But if you look at the history of euro-dollar futures, going back so many, many years, you see this amazing cycle that is almost perfect, repeating approximately every 5 years. And so I look at this chart and I say to myself, why do we need economists to tell us where interest rates are going to go? We can replace them all with one chart and save a lot of money. Look at the relationship. It's just truly amazing. Not perfect. Do not confuse amazing with perfect, but certainly quite amazing. So I look at things like this and I say, this should enable us not only to make intelligent predictions about economic trends, but in addition to that, intelligent decisions about investments. I have at the bottom of the screen another indicator. It says moving average 3, but it is not a moving average 3. It is a moving average of another indicator. I'll explain this in just a little while. Let me go to the next chart. On this chart, I've drawn some arrows. You will notice the lowest arrow on this chart on the bottom of the screen, right here in the middle, compares or correlates closely with the lowest arrow and the cyclical low in price, all the way at the bottom of the screen. Truly a phenomenal situation. So I've drawn these correlations, which you can look at later, and you can see cycle lows line up with lows on this indicator, which is a corroborating piece of information to the cycle. So you can see that we're not using the cycle by itself, we're combining something here. We'll talk about this more in just a little while. And remember, in 1 hour or less, I cannot teach you everything that I've learned in 52 years. Probably, if I had 6 hours, I could do that. And just let me say one more thing. I appreciate what Richard did at the beginning of the webinar, showing my book about psychology. Recently, I was interviewed by Stocks and Commodities magazine, and the interviewer asked me, how do you feel that your education in clinical psychology helped your trading? The answer was, it did not help me, it hurt me. Why? Because for years I believed that psychology and discipline were the primary ingredient in being successful in trading. They were not. They were the tertiary or fourth indicator in success. The most important thing was discipline, and discipline did not come from being psychologically fit. Discipline came from confidence. Confidence came from having a methodology that works. So the key for any trader is to find something that works. Of every 100 things out there that are available to traders, maybe 2 or 3 of them work. And we're talking about those that work, cycles. That's what we're talking about today. Let's look at another chart. The currency, British pound, GBP versus US dollar. The red line, a cycle, perfect cycle of 8.1 years, falling on the lows, almost symmetrical, but not necessarily so, for many years. And this in the cash market goes all the way back to the 1950s. And we can take that cycle and we can divide it into 2 cycles, about half the length of the long one, which is the blue cycle at the bottom of the screen as well, right here. Not perfect. The issue is this. It's not that we can't find cycles that are effective and predictive. We need to know how to use these cycles, because the cycle is only the first step. I can take a valid cycle like this and apply something else to it to account for or compensate for the fact that cycles don't perfectly pick highs and lows. They are not sine waves, they're cycles. So we can look at another one. The Japanese yen, US dollar relationship, truly amazing. And by the way, this is not new work for me. I've been showing these cycles for many years, and they don't change appreciably over time. Imagine the fact that back here, we knew what was going to happen in terms of low or high, not magnitude, but low or high, many years later. So we can take this information and, as I said before, correlate this information with other information that helps us determine timing. And as you will see, the key ingredient here, above and beyond the cycle, is the timing. So we can have beautifully effective cycles, highly repetitious cycles, but if we don't have the right timing, we have a problem. Because if the timing is off, especially in futures or where you're using leverage, you're going to lose money before you're right. And to lose money and be wrong by losing money when you could have been right by waiting is a great tragedy. Let's go to the next slide. S&P futures, and yet another cycle. And I want to stress again what I said before. Even though we can look at cycles like this low here, this low here, this low here, and this low here, you will notice red arrows where the cycle was either late or early. And again, this same issue. We can have all the cycles in the world. We can use the cycle finder tool, the analyzer tool on cycles, cycles organization, cycles.org, Foundation for the Study of Cycles website. But still, we won't make money unless we have some other super important ingredients. So I'm going to show you some of those today. Let's look at another chart. We've taken this chart right over here, and we've expanded that chart and looked at the cycles more recently. And I've added another piece of information to it. So here's that cycle, and I've added what's called market-generated information. In other words, information that comes from the market itself. Practically everything that traders do these days is market-generated information. In other words, prices generate moving averages, they generate trend lines, they generate RSI, stochastic, et cetera. But there's other market-generated information that's available to us all because it's published by the government, and that information is the so-called Commitment of Traders report, which comes out every week and answers the question, what are the three major categories of traders doing in terms of long or short positions? In other words, the Commitment of Traders report is a key ingredient in a decision-making process for the intermediate term. And let me stress at this point, intermediate term means exactly what it says. We're talking about moves that take place over a series of months, not short term. The cycles that you use need to be relevant to the time frame that you're trading. Many times people will call and they'll say, Jake, my 4-year cycle in stocks is moving higher. My 14-month cycle is moving lower. My 3-month cycle is moving higher. The seasonal goes down until the beginning of July. I have an intraday cycle of 16 hours. I have another intraday cycle of 3 hours from low to low. What should I do? My answer, go see a psychiatrist because you'll need one. The bottom line is this. I don't try to combine all the lengths of the cycles into one specific cyclical pattern that tells me what to do. The patterns and the cycles that I use are relevant to the time frame in which I'm trading. And so this piece of information, the Commitment of Traders report, I've added to this chart. So I want to show you a combination of things. I have here a cyclical low or projected cyclical low right over here. At the bottom of the screen, I have this little index, which appears to be interesting in the sense that when this number is very low, it correlates to market bottoms and cyclical bottoms. When this number is very high, it tends to correlate to highs in price and cyclical peaks. Not always, but many times. And so what is this information over here in green? The information in green is the Commercial Traders Index from the Commitment of Traders report. In other words, when the numbers are green, it means that commercial traders, who are these commercial traders? Banks, sovereign wealth funds, hedge funds, the biggest and best traders in the world who trade for positions, not for small moves. When the number is green, it means on balance, they are buying. When the number is red, which I've blocked out of the screen here, it means they're hedged. So for this particular purpose, and I'm using this tool only to find market bottoms, not to find market tops, you can see what happened. Right over here, the big traders were buying almost every month, every week. They started buying in anticipation of a cyclical low, and they continued to buy after the cycle reached its peak. After the cycle reached its bottom and started to move higher. Once the cycle was underway, they bought a little bit more right over here and continued to hold their positions. In the recently established lows in 2016, they repeated that same pattern. At the same time, the index on the bottom, which is the daily sentiment index, small trader sentiment, was very negative. So we had here a triple indication. The small trader, who is usually, but not always wrong at market turns, was negative. The big trader was buying, and the cycle said, yes, they are most likely on the right side of the market to be buying. So that's how we put some of this information together. I will show greater detail on this in future cycles webinars, but today I can't show it all to you because there's just no time. I just want to give you a little inkling. So how do we use this information? Let me show you something else. What about now? You will observe that this market crash right over here, which was part of the reaction to the COVID crisis, was accompanied by very, very negative small trader sentiment. It's an indication that the market is going to bottom. But we need another piece of information, and that's the trigger, which we'll talk about later. You will notice also that the biggest traders, the hedge funds, and the commercials, the banks, and so forth, were not buying this bottom. They were suspiciously absent from the market, which makes this rally that we've been in not as significant in terms of the big picture. We can talk about that another time. Right now, I just wanted to show you what's happening. So let me review. The cycle is the big picture pattern. The market sentiment of the small trader is a confirming indicator. The behavior of the big trader is a confirming indicator of a bottom, but we still need more information. And I'm going to share some of that information with you in just a little while. But before I do that, I want to show you some more things because this is very important stuff. Let's go to the next slide. We've taken the same concept, the cycles, and shown a daily cycle, which we found with the help of the cycle analyzer tool at Cycles organization at the website. You will notice again the relationship. Right over here at the cyclic low, the small trader was very negative. And here recently, just in the last couple of days, the small trader was very bullish, which is an indication that the cycle is topping. And you can see how that looks at the top of the screen. And remember, I'm only giving you part of the picture, not intentionally, because the picture is a little more detailed than this. Not complicated, but a little more detailed. I have more things I want to show you that are much more specific. We can look at the crude oil cycles over here, and you will observe small trader was the most bullish they had ever been right over here at the top, right over here at the top, and most recently at this top. And every one of these correlated with or preceded a peak in the calculated cyclical pattern. Let's look at some more information. You may not be a trader of soybean oil, but when you look at the cycle and how regular it is, you may decide you're interested in trading soybean oil, even though soybean oil has no sex appeal whatsoever. We can take that cycle and divide the cycle into several others. So we've got the big cycle in red, the 1/2 cycle in bluish green, and on the bottom of the screen, we've also got cycles on the sentiment of the market, which is a whole nother topic that we'll talk about in future webinars. What I'd like to do is get into something much more detailed. Here is a chart that I found in one of the issues of Cycles magazine many years ago. At that time, the chart had only been updated to the 1970s. This is a chart of real estate activity in the United States, and I believe Bill Cerubi showed yesterday what he called the 18-year cycle. This is what the foundation many years ago called the 17 1/3 year cycle in real estate activity. The solid black line shows the trend of what actually happened. The dashed black line shows a perfect zigzag of 17 1/3 years. I took this chart from the magazine and extended the actual and the dashed lines to show what would happen. And therefore, in 2010, which was right over here at the bottom of the cycle, I projected in my work and in my personal investing a bottom in the real estate market. Since that time, I have not bought a single piece of real estate that has not made money. Every piece of real estate that I bought has made money. In fact, the house that I'm in right now has more than doubled in value in just a few years. Why? Because the projection of this cycle indicates a peak, ideally between 2020 and 2021. Bill Saruba yesterday, independent of my work, I'd never spoken to him about this cycle, projects 22 to 23. Either way, this is another example of the kind of work that you can get from the foundation and the kind of work that causes me to be so excited and passionate about being a member of the foundation and about continuing with this research. But let's get even more specific. One of the investments was right over here, buying VNQ in 2010, the real estate ETF, showing what has happened since then, and another real estate ETF, XHB. So you might say, well, if you did in fact buy it over here, all the way back here, what happened right over here? That is the third part of the process we do called risk management, profit maximization, trailing stop, in other words. More about that later. Okay, so look, the bottom line is this. No matter what you do, no matter what kind of cycles you find, the most important thing is this. A cycle gives me direction, probable direction, and possible trend. It never gives me an indication to buy or sell. Never, never, never by itself. If someone tells you they've got a cycle of 17 and a half minutes and it's been perfect, don't believe them. It's a lie. It's not true. The cycle is like an automobile frame. It needs a source of energy, and I call that energy a timing trigger. The trigger requires action, and action then requires risk management. So let's take this one step further. I'll show you. If there is nothing you can come away with from today's presentation, other than this list and these two slides, numbers 1 through 19, please come away with this. No matter what you do, no matter what you follow, cycles, Fibonacci, Elliott wave, Gann, whatever it is, you need to know these 19 things before you make a trade. Even if the trade is inspired by cycles, you want to know all of these things. These are very specific things. They're objective, they're knowable, they're not interpretive, they're not subjective. They're clear and crystal clear. If you have a methodology that does not tell you all of these things, or at least half of them, you're going to have a problem if you don't already have one. So while we can go to these cycles analyzer and draw these perfect cycles and say, computer, plot the cycles in this data series and give me the Bartels, which is the level of significance, and it looks great on a chart, it will still mean nothing to you in terms of making money because these highs and lows are ideal and they need another piece of information. And the same would be true with this cycle, which is a combination of various cycles. And even though it looks good on paper, it still needs a trigger. So I use rule-based trading, cycles, and seasonality, and I use a trading model. And here is my most important rule. Don't be stupid. Use a trading model. So what most traders don't understand is that trading is a business and it requires you to make sense and money through the use of systems and methodologies. So if you look at this combination right over here, setup, trigger, and follow through. This is my trading model. You can certainly make it your trading model, and if you're not already using something similar to this, I think it will help you. But I want to show you some amazing things before we run out of time. A setup is a trigger. A setup is a pattern. There are literally thousands of patterns. Reversal, key reversal, head and shoulders, trend line, momentum divergence, blah, blah, blah. It goes on for days and days and days. The good news, there's thousands of patterns. The bad news, most of them do not have predictive validity. So the first challenge, find a setup that's reliable. How do you know if it's reliable? Put it on the computer and test it. Second, once that pattern has been found, use a trigger. A trigger is a timing indicator. In future webinars here, I will show you those. Once the setup is triggered, you need follow through. The part that most people have no idea of how to do. Follow through consisting of 3 things. Number 1, what is your risk? Where are you wrong? Number 2, where are you right? to reduce your risk effectively to zero. And number three, how do you maximize the profit? Everything I do begins with the cycle or the seasonal or the pattern and ends with the follow through. And it answers all of the questions on these two lists right over here. Where are those? Here they are, these two lists. Let me give you an example. I'm going to be very specific with you now. So you've got all this information. And remember, don't be stupid. So check this out. Let's talk about the so-called 50 and 200-day moving average. The golden cross, when the 50 crosses above the 200. The death cross, when the 50 crosses below the 200. Put it on the computer, ask the question, does it work? Here's what you find. Yes, 41% accuracy. I'm not interested in that. 6 consecutive losing trades. All of the statistics. I've got the numbers. They're just no good. I need something better. So what am I going to get that's better? If you have not read the book, The Behavior of Prices on Wall Street, strongly recommend you do that. In fact, highly recommended, better than my book on trader psychology. Merrill found that days before holidays in the Dow Jones, going all the way back to the 1800s, were usually up days. Usually meaning well over 70% of the time. So for example, if we take something like this, USA Thanksgiving. If we take New Year's Day, Good Friday, July the 4th, Christmas Day, Veterans Day, April, let's see, there's a few others, and I can't remember them all anyway. But the bottom line is this. Every major US holiday has this pattern. You buy the day before the holiday, and you get out the next day. Example, USA Thanksgiving is always on a Thursday. You buy on the close of trading Tuesday, get out on the close of trading Wednesday. You're in the trade one day. The numbers, 73% accuracy over the last 62 years. Now, I've got an idea here that's very important. It gives you numbers, it gives you statistics, it tells you exactly what to do. It's a pattern. You can call it a seasonal cycle, a seasonal pattern. And then we can go to the computer and we can do some more stuff with it. What do I mean? Example. If I go to the computer and I ask the question, is it possible that the USA stock market, as measured by the S&P and the Dow Jones, begins to move higher before this pattern happens and continues after this pattern happens? Is there a pattern here that's cyclical or repetitive in nature? So we go to the computer and we ask the question. And remember, this is all 100% objective clarity. It is not interpretation. It is not subjective. It is crystal clear. So here is one of my uses of a cyclical pattern, which is the annual cyclical pattern called the seasonal. And what does it show? It shows that buying September S&P futures at the end of the day, November the 20th, or the close of trading the next business day, if the market is closed on November the 20th, and getting out on December the 4th, which for some people is a long-term trade, to the start of futures trading in S&P has been right 81% of the time. It's had a profit to loss ratio of 17-1. It's had an average profit of 19.83 points, average loss, percent average profit, percent average loss, maximum number of consecutive wins, etc., etc. And if you go to the history of this trade, you can see every trade that it made all the way back to 1983. So when I talk about objective criteria, this is what I mean. This cyclical pattern allows me to take the overlying pattern, which is the pre-holiday behavior, and do some research on the computer and find the ideal combination. Now, somebody might say, well, when did you find this? if I say to you, I found this in 1997 and studied it all the way back to the 1800s in the Dow Jones, you might say, well, now you've got a valuable piece of information, because you will notice that since 2002, it has been correct every single year except 1 year where it lost a little bit of money. And every year, the litany is the same. It's not going to work this year because. It's not going to work this year because we've got the COVID virus. It's not going to work this year because President Trump's an idiot. Whatever you say, it's not a question of whether it's going to work or not. It's a question of whether you can afford the risk. The pattern is there. The idea is, does it trigger? Does it tell us that the trade is appropriate for your account and risk? Because that's the third part of the setup, trigger, follow through process. So you might say, well, look how well it did in 2019. It made 61 S&P points. Surely it could not have worked in 2020. And here's the track record. And you can make all sorts of excuses and say, well, it's been doing so well, it needs to have a setback, it's due for a correction. I don't do that. My only question is twofold. Number one, did it trigger? And I will teach a trigger in future webinars here. And number two, can I afford the risk? Do we know the risk? Sure. The risk is right over here. It is 3% stop loss of the closing price on the date of entry. So I calculate that number out and decide, is that risk too big for me to take? If not, how many positions can I take? If the risk is too big, can I find a smaller contract? Can I find an ETF? Can I find an option? Can I find a leap? Can I find a spread, a strategy that allows me to participate in this trade without interpreting whether it's going to work or not, but in other words, determining, is the risk correct for me? So how did the trade look this year? Here's the trade. The entry date, right over here. And by the exit date, which was right over here, it had already achieved its first target, allowing me to manage money, take some money off the table, reduce my risk effectively to zero, and participate with a trailing stop to maximize my profit. Then the doubting Thomas would say, aha, yes, Jay, but you missed this big move. What about this big move? No problem. That move was part of another cycle that allowed me to enter. And furthermore, by going back to the computer and saying to the computer, were there any more trades coming up in December that would have allowed me similar accuracy? Searching for trades with 80% accuracy by computer, I got this one. Buying December 22nd, getting out January the 7th with 78% accuracy. And that trade looked like this year, also achieving its target. So let me review a couple of things for you. What have I shown you here? All the way back to the beginning. There's a seasonal pattern, there's a cyclical pattern. The seasonal pattern is a subset of the cyclical pattern. Both of them have extremely important value in the process of using setup, trigger, and follow through. Setup as a pattern, trigger to make sure the pattern is going to be accurate this year, not 100%. And number three, managing risk to make sure that when you're right, you make the most you can make. When you're wrong, you lose the least you can lose. That takes me all the way back to the beginning of my education in trading, all the way back to eggs and the cycles, which is one of the reasons I'm so passionate about the foundation, because the foundation has been a great thing for me. Unfortunately, it laid fallow for too many years until Richard resurrected it. Let me show you something else. Let's look at this. Another one, February, but you're probably more interested in something else, which is this. Let me show you what I'm talking about. Let's say that we took all of the years of the Dow Jones from 1920 to 2019. We are talking here about, literally speaking, 100 years. We made one chart, a composite chart that showed the Dow Jones in the typical year. And on that chart, we put percentage of time up or down by week with the green arrow or red arrow, and we highlighted certain areas as important for up moves or down moves. I want you to look at the first 2 weeks of July with the red arrow at the bottom of the screen, right here. It shows the first 2 weeks of July coming up as bullish weeks, not over a period of 5 or 10 years, but we're talking about a period of literally 100 years. Can we take that very valuable piece of information, which I will of course share with the foundation, and turn it into a trade? Absolutely. Look at the chart. We go to the computer and ask the question, show me trades in June and July for the S&P 500 that have been right 70% of the time or more. We search, and computer gives me this. And guess what? Today's date is what? Is today the 25th? The 26th is Friday. The 27th, 28th, and the 29th is Monday. The history of this trade says, buying S&P futures, close of trading June 27th, or the close of trading the next business day, getting a close of trading July 1st, or the close of trading the next business day has been right 76% of the time. And I can see the history of the trade. And here is that seasonal trade from Art Merrill, the behavior of prices on Wall Street, showing in actual, in the flesh. Well, you might say, but Jake, we need more data. We want more data. Here's the track record, very impressive. So you say, okay, are there more choices? Sure. There's a lot of choices we can make. We can start the trade as early as the 24th of June, right down here on the table. But remember, you decrease the accuracy. So here's all the relevant statistics. So here's the coup de grace. We take this trade and say, let's take this back all the way to 1920. So we're talking 100 years of a specific trade. And here's the result. Dow Jones, 1920 through 2019. Almost 100 years of history and data. Very clear, very specific, but here's the deal. 78% accuracy with a risk of 6%. Now, I want to tell you this. I am not guaranteeing you this is going to happen because remember, even with 78% accuracy, which statistically is a very impressive number, it's not perfect. I will use a trigger to get me into this trade. But think about what I know and what most people don't know. I know whether to buy or sell. In fact, I know everything on that list that I showed you before, all of those 19 things. I know everything with one exception. Will it happen again this year? And here's where the psychology comes into play. Most people will look at this chart and say, oh my God, it's gone parabolic. Where was I 30 years ago? I have been showing this trade for 25 years. And people will say, but it's gone parabolic. We know that this won't last. It's got to be a losing year this year. Don't think in those terms. Think about whether the trade triggers and if you can afford the risk. So the most important tool, if you can't test it, don't trade it. And remember, many strategies are intentionally vague so that the purveyors of those strategies will get you to buy what they have to sell you. The foundation does not want you to buy anything except a membership. At the foundation, you will get a vast amount of data. You'll be able to do research on the data. You'll get reports. You'll get Cycles Magazine and many other things that we have for you. And remember, Richard and I and the members of the foundation board of directors, we're not interested in making any money on this. We're interested in bringing you valid information that you can use to improve your lot as a trader and give back, at least to my extent, to give back what the foundation has done for me over these many years. Not only has it given me a perspective on trading that has served me well, but it's also been helpful to me in my life because in my daily life, I see cycles that repeat over and over again. The only thing that's different is the players are a little bit different, but the strategy and the patterns are the same. So Richard, I am effectively done. I want to thank you for giving me the opportunity to be here, and I'll turn it back to you.
Jake.
Did I finish on time?
You did perfect.
Good.
Thank you so much. I'm glad you asked me not to talk because no reason I should be talking because that was just absolutely delightful. I just have to come back. I just want to make one comment that really struck me. And Stan Ehrlich is here now, so I can actually let Stan in the room too. Hey, Stan.
Hi, I'm turning on my video now and hanging up the phone, right?
Don't turn it on yet. Just hang tight. Jake and I are just wrapping up. Take your time, settle in. We'll be right back.
Okay, I'm just listening to you on Zoom, but no picture, no video yet.
Got it. No problem. So, you know what struck me, Jake?
What's that, Richard?
Besides going back to Seasonal Trader, you know, and remembering working on that with you 20 years ago, kind of made me want to cry almost.
Oh.
But, and it reminded me of Bill Sarubi's work, you know, which I coined as offensively simple, you know?
Yes.
It's like, it's so simple, and yet it works. And, but you said your psychology didn't help you.
No.
That was very striking. You said discipline comes from confidence, and confidence comes from having something that works.
Correct.
And that really hit home. You know, I hadn't really put it that way before.
You know, Richard, it hit me like a bolt of lightning when I realized that for 15 years, I struggled to find a great methodology.
Yeah.
And I didn't have confidence because the methodology that I had wasn't working.
Right.
And there's no reason to have methodologies these days that don't work because we can test them. And then you build your discipline from your confidence.
Fantastic. Well, I know we'll be talking more. You're a board member, very important board member of the Foundation for the Study of Cycles. And
not only that, I wrote a check.
that you wanting to give back, and we will give you many opportunities to do so.
Thank you, everyone. Thank you, Richard, and thanks everyone who presented here, and especially to our audience. Very, very happy that you guys are so interested in what we're doing. Thank you so much.
You set a new high bar, Jake. Everybody was glued and didn't leave. So thank you very much.
Thank you.
We'll talk soon.
Bye-bye, Richard. You can dismiss me from
there.
Richard?
Yes, and Jake, go ahead and stop sharing your screen.
Yep, let me do that.
Hi, Jake.
Stan,
hey, Stan, how's it going?
Good. How are you doing?
All right, hold on one second here. Stop sharing. Okay, I'm out of here, guys.
All right. Bye, Jake.
Later.
Bye-bye.
Bye-bye.
Stan, welcome.
Turn my camera on.
If you would like to turn your camera on, feel free. Oh, nice. You upgraded.
Richard. Yeah. I spent lots of money on this little thing behind me.
Looks great. Well, welcome.
And I put a clean shirt on. There we go.
How you doing?
I'm doing fine.
Good. Thank you so much for joining us.
And I'm so happy to be here. Thank you for asking.
We've had an incredible week. I think you've been following along a little bit, right?
I have. I've heard all the speakers except for Jake this morning. I've heard him a few times.
Well, he just gave an incredible presentation that
I'll listen to it later.
100 of his other presentations, which I think maybe you have, because you guys have crossed paths a few times, right?
More than a few, yes. Jake and I are old buddies.
Yeah. So really looking forward to your presentation to help us wrap up day 4. And I think you got a lot to talk about. So
a few points. I managed to finish up a little presentation that I hope everybody likes.
Yes, and Stan, you and I, here, let me mute Jake here. And there we go. You and I hit it off immediately because we're both systems guys.
That was your opinion, but yeah, that's fine.
We both love cycles.
Yes, we do.
And we both appreciate the role that risk management plays. And
big role.
And really using tools to help us kind of overcome what Jake just said of don't be stupid, right?
That's the beginning. Yeah, absolutely.
And it
planning is a very big part of it.
What your IQ is, how facile you are with spreadsheets and numbers and computers and charts. how knowledgeable you are about indicators. It really comes down to, as Jake said, having something that works and overcoming your own biases.
That's right. You are your worst enemy. You've heard that a million times, and it is so psychologically true.
Right.
It is a major problem with most people as far as trading is concerned.
So folks, Stan started in the futures industry in 1971 on the Chicago Futures Exchange. So you were there in the thick of it.
Right in the beginning of the Russian grain deal.
Yeah, you know, you've mentioned that story a couple of times. Maybe if we get to the end and we have some time, you could actually tell it, because I haven't heard it yet, but I'm very interested. So today you're developing automated trading systems, is that right?
That's correct, the Ehrlich reversal, yes.
And you've been a broker, you're a Forex dealer member, you've been on CNBC, you've lectured for all over the world.
More than once.
And you're also the inventor of the Ehrlich cycles finder.
Oh no, you found one.
I found one. So what is this?
It's a hamster gate.
A hamster gate?
A hamster gate and a long distance back scratcher. In 1977, I came up with an idea of a tool that will help you find rhythms on paper charts. So you would lay this down on a paper chart and expand it and contract it across the bottoms or the tops of the price action for whatever time frame you have available on the chart, and it would automatically pull out the most dominant cycles on the chart because you will see them first. So by expanding and contracting the tool, you found a rhythm, you shifted 1 unit of time, meaning a rhythm of time, into the future, and you have forecasted the next potential cyclic high or cyclic low. It's just as stupid and simple as that. There's 20, 30,000 of these rolling around the world. I am so tickle pink that it became popular for 2.5 decades, 3 decades, until the computer put me out of business. It works. It works.
It's quite, it's a
Larry Williams got one. Several of your speakers in the last few days have got one. You have one.
I have one. So let's get into it.
Yep.
As Jake just shared with everybody, discipline comes from confidence, and confidence comes from having something that works. So how about we show everybody something that works?
I'll start my PowerPoint now, right? Excellent. And occasionally I'll flip back to TradeStation real time if I need to or want to. And whoever's monitoring this and has the ability to provide me with a question from somebody toward the end, I will try to do the best with that.
Are you okay if I interrupt you once in a while midstream, or you want me to save it all for the end?
And no personal questions, please. Other than that, yes, of course, that'll be fine.
Very no problem. Well, I found it's best if we turn off our cameras while actually going
I understand.
Slides.
Goodbye. So can you still hear me? I can hear you. Good.
Yep.
And I'm going to share my screen now.
Yes.
Just a moment. And I think, no, that's not the right one, is it?
We got your history repeat itself. Looks like a good start to me. I'm not sure if that's
okay. Good. Excellent. We usually have a yellow circle square around the screen, but I don't see that at the moment. So this is my first slide. History repeats itself, and cycles are all over the place. It's everything. The world we live in is full of them in every form you can think of, even outside of the world. So learning from the same thing happening again and again is terribly important, because we tend as human beings to repeat mistakes unless you learn from history. We try to see them, find them, measure them, and therefore potentially predict them. And when I'm talking about them at this particular summit meeting, it means market cycles, etc. So Jim is actually calling me. I'm going to hang up on him. Sorry, Jim. And no, I'm on the air. Bye-bye, Jim. So timing, measuring early. Sometimes you'll be psychologically prompted to get in a little too early in a cycle, maybe too late. You might miss the whole thing, and you're learning from your experiences. I'm going to talk about the WOO. That's my little nickname for window of opportunity. It is a small percentage of the cycle around just before and immediately after the peaks and troughs, the tops and bottoms of sine wave type cycles. I'm going to show a cycle that is actually a cycle of cyclical lows in the S&P 500, the spider, that I think you'll be impressed with. I was. And using a series of technical tools to help you be convinced that it's time to get into a trade in the WOO, in the opportunity time period. There is self-money management built into this. You don't necessarily want to trust markets all the time. They are fickle. When I see cycles turning before, during, and after, and then look back historically at what I would try to figure out why this time the cycle worked or didn't work, it is different. I have found that there doesn't seem to be much consistency with the underlying reasoning as to why the damn thing keeps repeating itself. But it does. So one of my little adages that you claim you like was Lily Lipper and Sirabid, which is limit your losses and let your profits run, and sell into rallies, buy into dips. If you're going to get close to the top of the market, you have to learn how to sell under rallies to some extent or another, or of course, buy into market dips or breaks or, of course, crashes. It's the scariest thing. Next slide. Okay, the Ehrlich cycle finder we have touched on already a little bit. Finds dominant cycles visually, automatically averages their length, automatically forecasts the next potential cycle high and low, measures tops and bottoms separately or together on any data, doesn't have to be price action, any chart, any market worldwide. I've used it on Chinese charts that have a label as a number. There's no real company name. It's corporation 564321. Measures on all Fibonacci retracements as well for you. I'll show you that. I have a quickie little story. When I was on the seminar circuit showing people how the cycle finder worked and lecturing on rhythms in markets and cycles, there was a small group of people around my display table in the exhibitors hall. One gentleman pushed his way through the group of people and dropped a very large chart on the table in front of me. I was, of course, working with the cycle finder and something else, but he said in broken English, "Please find cycle." So I stood up, I looked at the chart, probably about 3 feet wide by 2 feet tall, so it's a fairly large chart. I looked at it very closely and I expanded the cycle finder and dropped it the 6 or 12 inches that it was above the chart onto the chart. It landed perfectly on a cycle on that chart. I couldn't have done it better if I spent hours doing it. He just stood there gasped at what he just saw. And the rest of the group went, "Oh my God," and all that kind of emotionalism. He promptly bought 2 cycle finders, one for his secretary and one for himself. That's my little story about Kuala Lumpur. Finding cycles from symmetrical formations really helps, by the way. We all know, most of us know, that a head and shoulder top or bottom formation is typically relatively symmetrical. The distance from the first shoulder to the head of the formation is, I don't know, a week, a month, 6 months. And the distance from the head of the formation to the last shoulder high or low is approximately the same amount of time. Now, they can be a little bit asymmetrical, but usually they're fairly symmetrical. So when you find a head and shoulder, you may have found a historical cycle. All you have to do is lay the tool on the head and shoulder with the points to the 3 parts of the formation, and then backward in time, the other points of the tool may land on a series of tops or bottoms. How simple can that get?
And you can
So
still use your cycle finder even on your computer screen today.
that's exactly correct. I wish they were magnetic, but the tool would have stuck on the screen vertically, but you have to hold it up on the screen, but it can be done, certainly. Especially today with big screens, it makes it better for large charts. It's really nice. Next slide. And there we have my little cycle finders pop up on the upper right and left. Here is a chart of the S&P 500 with a 52-day cycle, which I will talk about more later. The tool, as you can see,
that's great.
Pardon me?
I love that illustration, speaking of putting it on your computer.
Oh, not the first time. So I put little vertical red lines manually on the chart to show you visually how the lows actually line up with a small time period on or close to every vertical red line, which is 52 days apart, period. There's a little series of green dots that you can see at the bottom, which is the woo. That's the window of opportunity. And that's the bottom of the sine wave. We have erased the rest of the sine wave going up, topping out, and coming back down again, only leaving the little cups at the bottom.
Wow.
It's kind of cute.
Yeah, I like it.
Now, that I think will pop out at you as being what date? You remember this one? Most speakers have mentioned
December 23rd, 2018.
24th December
of
18, the day before Christmas.
Yeah.
But they claim that this date is the important date, when in fact, it was the day after Christmas, the December 26th day, which I think it was a Wednesday, that had a bullish engulfing in an oversold condition, very oversold, on the 52-week cycle low, and created as a result a bullish Ehrlich reversal signal. And I'll go into a little more detail about the parts of it. But the main two things are oversold and a bullish engulfing. We turn the price action green, nice little trick, and it was an incredible signal. Next slide.
And it was right in
I'm going to get into that a little bit more. And I'll show you that chart again later. It's the highlight chart of the hour. You can measure all of the important Fibonacci retracements with this damn tool. Using the low or the high and vice versa, you get 12.5% between each point. You can see my cursor, by the way, can't you?
Yep.
Good. And therefore, you've got the variety of percentage retracements, of course, 618, 50%, and 382. What are we looking for when we're looking for a signal? And we're talking about at cycle tops and bottoms during this hour. Frankly, my strategy in TradeStation will generate a buy and sell signal outside of the woo, as you might expect. But the ones we're concentrating on are in the time frame where you're expecting markets to turn up and down because of a historical cycle that you found using the Foundation's scanner for cycles or the Ehrlich cycle, whatever.
Yep.
So I look for at least 1 million shares on a daily average, 10-day moving average. I look for prices probably between 20 and 100 bucks. Above 100 is a little expensive, but the price range is flexible. And I look for an average true range of at least $1 a day. So that's one. And this can be scanned for in TradeStation. The relative strength is a customized relative strength index. And I learned RSI from Wells Wilder himself in the early years. So we have a tweak on the way it's calculated. And basically, the old-fashioned 30, 70, 14-day look back will work in a satisfactory manner. Also, the key reversal is a slight variation on Steve Nissen's standard. I like an outside day, which means the high is higher, the low is lower, but the closing price only has to be above for bullish the previous close, not necessarily above the previous day's high, which is Steve's interpretation. So I'm a little more lenient, higher high, lower low, and a higher close, not a close above the previous day's high. That's what I'm looking for. When I see that, the computer sees that, the code sees that, we turn the daily bar green. For exits, we're looking for on 1 minute charts. Once we get a green daily bar, we immediately switch to a daily 1 minute chart. We use a little trick we nickname baby blue because the color of the line is blue. And we actually trail our entry signal a very small percentage in order to improve the entry after we get a buy signal. Today, the market's oversold. And I'm just theorizing here. You could use a sample symbol ABC. It went down for a week. It's oversold. Today, the market opens lower. It got below yesterday's low. There's a rally involved. We're back in the middle of the range of the day. It's getting stronger and stronger. Our strategy realizes that we might have an oversold symbol with almost an outside trading range. We see that on a list that pops up, put the symbol in a 1 minute chart, run the strategy on it. Once a higher high, if it happens, occurs immediately, ER1, the Ehrlich reversal 1, kicks in and tries to buy it as judiciously as possible using a buy stop market order that floats around a little bit, but not much. We don't let it run away. We let it come down some maybe, and then buy it as long as all the criteria are still appropriate. We immediately, when we're filled, which is almost in a minute or two, sometimes 5 or 10 minutes later, that'll be when it gets a little cheaper, and that's good. We apply the next item, the STS. That's Smart Trailing Stop. It is adjustable. It's the money management form, and it takes you out of the trade if it turns bad, and you can adjust the amount, and it follows prices, and you'll see a bunch of charts in a short minute that do very, very well. I realize we're around 22 minutes after the hour, so I'm going to speed up a little bit here. We also I love RSI. I learned it from Wells Wilder himself. Percent target, we allow you to apply a target price based on a percentage, which is an automatic adjustable. And if you want adjustable by the average true range figure, which changes daily, so it changes automatically. Next screen. I did want to mention that these reversal signals frequently happen at, and when I mean at, I mean the low day, December 26, 18, the day after Christmas, or extremely close to the turning point of the market, which is in the woo. And I didn't comment, I like a woo of about 5% before the cycle low, if it's a 100-day cycle, 5 days before and 5 days after. So I've only got a 10-day opportunity if I'm going to take a signal in the woo. Next chart, screen, slide, whatever. ER1, if bullish, we turn the price action green. And if it's bearish, we turn it red. The same day that the ER1 occurs, we're in the trade. There's no runaway possible. It can't run away from us because we put a stop in immediately to catch the move at extremely close, probably 5-10 cents away from current close. And that means even a $100 stock, 5 or 10 cents away. So the key reversal just occurred. There's no procrastination. We're using that little baby blue technique, and immediate STS, smart trailing stop, is placed. You like the phrase. I like it a lot. It's a protective stop. I don't like stop loss. It implies a loss. This stop can be used to get out at a loss, but it moves quickly and will protect the profit if the trade works out adequately, very quickly. In the opportunity, window of opportunity, we're trading, which again, often is at highs and lows in the market. This ER1 trade, and we have one more coming up in a moment, is slightly riskier and will be sometimes in the first few minutes or the last few minutes of the whole day. So nobody is fast enough to keep up with these signals than a computer. Our first example.
Let's see how it works.
That's how it works. Here we go. This is a daily data chart on the spider, and it was only, oh my God, 2 weeks ago. Everybody sees this. It's only 2 weeks old. It was an overbought condition. It had a red bearish engulfing on my chart. We sold it short when it made a low lower than the previous day's low.
Bearish engulfing means it completely consumes the previous bar.
Engulfing, correct.
And does the close have to be lower than the previous low?
The current quote during the day.
During the day, okay.
Has to be lower than the previous day's low to make it an outside day, an engulfing. Okay. And we assume that the close is going to be lower. If it's not, and we're already short, which happens fairly rarely, but sometimes, we have a day trade loss. We're out. It didn't work. The signal is nullified because the closing price doesn't allow the red bar to stay red. It turns yellow again.
So
yellow means overbought.
Interesting about this, the concept of the woo is great. And it's basically 5% either side of the cycle length, right?
It certainly is adjustable. That's just my preference.
Right. And then, a lot of people look at cycles and are looking for, reversals, right? A cycle sort of naturally makes you think of a reversal.
Sure.
But, oftentimes, the reversals don't come, right? Especially.
Hey, you can't catch every trade, right?
Can't catch every trade. So what you're sharing with us here is a strategy for how to kind of take the cycle as the woo of the cycle as kind of the target reversal point, but then actually
in time
have a real strategy for confirming, like Jake said, a trigger for actually taking that reversal.
Let's not get carried away with words that are static, yes and no. It's all gray matter, right? It's all gray area.
Yes.
It's confirming, I'll accept.
Yes.
It tends to be right most of the time.
Yep.
But this doesn't necessarily produce a profitable trade. It would confirm that you've gotten a signal, but is that signal going to turn out to make money?
Right.
So, okay, so there we are. Got that straightened out. Higher high, lower low than yesterday. Current quote, now lower, that moment, this minute, literally this 60 seconds lower than yesterday's low, sell it short. Now, you might have a little loss in the close. You might have a profit on the close, as long as it doesn't go up to this yellow line at the top. And I just changed charts by clicking my mouse, force of habit, right? As long as it doesn't go up to this STS line, it's our protective stop. We don't get stopped out. We give it elbow room, which as the market goes down, begins to diminish very quickly. Next chart. Here we have the symbol DIN. I have no idea what the company is, does, or what the real name is. I don't care. I'm a technician. It doesn't matter. It gave me a sell signal, a big one. The size of the red bar is not particularly important. I've had signals that were fantastic with a small outside day, and some like this, which is very big relative to the previous day. We're short when it made it below the previous day's low. This one dropped like a rock. I'm not going to show you any bad examples. I'll tell you that right now. And it went flat for a bit, and for about, 2 to 3 weeks until we finally got stopped out when we got extremely oversold and it started to rally. Next example. This is IOVA, daily data. As it got lower than the previous day's low, real time during that date, which was the 23rd of April. We shorted it. People can take a look at their own charts and see this. That's why I've got the dates on the bottom and the symbol there. I'm not hiding anything. It came dangerously close to stopping us out 2 days later, but did not hit the yellow line. It might have missed by a penny. And rarely that happens. Now that, makes you want to think, I'm going to get out now before I get a larger loss and not take such a large loss. But that's breaking the rules. This is an algorithm. It don't think, it don't care. It's not emotional. You do what it tells you to do, or you're not following the rules. Down it went by the end of the day. lower than the previous close. Now you're brushing the sweat off your forehead, going, whoof, just missed that one. And the next day you're feeling pretty darn good that you're still short. And now down until we get stopped out. I'm not going to show you very many trades that last a long time, a few, but I'm trying to get some detail here, and you really can't do that if you have 2 years on a chart of daily data. So we're short when it has a lower low. Trade goes down, and we're still in this trade now, today.
Wow.
I'm not out.
That's
We
great.
missed getting hit. We missed getting hit yesterday, day before yesterday. I did this chart yesterday. On the 20, what is today? What's the date today? 24th?
This is Liper.
25?
Profits run.
Yeah, that's right. But no, the date today is the 25th, isn't it?
Today is the 25th. Yes.
So yeah, I did this yesterday. And nothing really happened of significance today, a little bounce. Anyway, still there. Now here is the same strategy, ER1, on a daily 1 minute chart. You may not see the vertical line that separates day from day, but we have entered on the 15th of June, June 15, 1-5, as it got higher than the previous day's high. I can't draw a horizontal line on the screen. It's going to screw things up. So it popped up, came back to about where we bought it, and never was a loss after that. Next morning, gapped up a bit, settled back to close the opening gap, closed, didn't do much the next day, blah, 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 up it goes. Finally, and you see our yellow smart trailing stop follow minute to minute. On the daily chart, I couldn't show you minute to minute, but in reality, it tracks prices and makes adjustments when necessary every single minute. How do you do that if you got 20 or 30 trades on?
Got to use the computer.
Thank you. Next chart. ER3 is a slight variation, and I actually like this strategy better, of ER1. And we're a little more than half past the hour. Good. So lots of times the market retraces back into approximately the middle of the range of the ER1 bullish or bearish engulfing day. Let's pretend it was yesterday that we got an ER1 trade signal. Bullish or bearish, I don't care. Today, prices move back into the middle of yesterday, and that's where we want to get into the trade, obviously in the right direction. If it was a bearish signal yesterday, we're going to be selling short on a rally, probably a rally. And that's exactly what the strategy does. Now, we allow 3 days to do this, and a little over 50% of the time, ER1 just runs away, and we never get a retracement within 3 days, and we never have an ER3 trade. But two things happen with ER3. If the trade goes sour, it's already back in the middle of the range of the key reversal. Our loss is less. We'll get stopped out with a smaller loss. And that by default means if the trade is good, we have a larger profit. I kind of like that. So ER, although it doesn't happen almost 50% of the time, not quite, is frankly my favorite of the two. It's a mid-range trade. We do use baby blue technique as the entry, part of the entry process. Again, there's no procrastination. It's done for you automatically. We immediately have the trailing stop, just like ER1. This happens in the Woo because, again, it's usually within 3 days or less, almost always within 3 days or less of the actual ER1. Often the next day. Lower risk, bigger profits. Sometimes within the MERST first minute or two, first minute or two, or in the last couple of minutes. So it can happen very early or very late. You know how markets sometimes open sharply higher on maybe a rumor or in some news or something, who knows? And all of a sudden, bam, the stilts are knocked out from underneath it, and it crashes to lower than yesterday's low after opening above yesterday's high.
Yep.
And that's an outside down day if it's overbought, if it has a million share average, if it's above a certain price and within a price range, and you get this key reversal, our algorithms will go short.
So what you're showing us is when you see a cycle top or bottom, this is a way to really look for whether or not you're getting a true reversal opportunity near those cycle tops or bottoms.
Absolutely. There are plenty of methods to trade any old time.
Yeah.
But we're, again, concentrating on a small time frame around the turning point. Why do you look at cycles in the first place? To see if you're going to get trend changes in historical statistical data that will predict the next potential swing up and down.
Right.
Hey, if I'm going to be alive for the next pandemic, I'd like to know when it's coming. Right? Right.
Yeah.
Yeah. Okay, so here's an outside down day. We sell short in the middle of it the next day. Good trade, obviously, coming down. Here's an oversold outside up day, probably responsible for us getting out of the short, but not necessarily. But it's the forced, mandatory money management with the yellow STS line that is important here. Next example, bearish engulfing red. Middle of the range happened to be a little lower than the opening, so the opening is immediately a candidate for a fill. The opening was higher in the middle. Why not get short here? It's a better price. If I'm wrong, smaller loss. If I'm right, bigger profit. Mm-hmm. Down it goes after fiddling around a little bit. You can see it rallied a little bit more, apparently. And right away, our STS protective stop is now protecting a profit within a damn day because it dropped so much the next day. So a little recovery and downtrend some more. Next chart.
Average true range for that protective
stop? Average true range. Okay. We won't go into the calculations for ATR, average true range. It's fairly common on most trading platforms.
Can you give us a ballpark on these 1 minute charts? What are you using?
On the 1 minute, I'll show you in a moment. There's another one coming up.
All right.
Okay, so you can pretend this is a 1 minute, but it's not. It's daily for COLD, cold.
Daily.
This is daily. 1 minute would be much tighter. You'd see the data much closer together. So here we have a green engulfing, and the next day it came down lower than the middle, so we're buying it as it comes down around the middle. Jumps, comes down a little bit, not low enough to hit our stop. Comes up a little bit, stop starts to come up. Prices rally, our stop is almost hit, not quite. Look, almost doesn't count, but in horseshoes and hand grenades. So we're still in the trade. Comes up some more, and finally prices drop below the yellow line, and we're stopped out here. Next chart, 1 minute. WPM had a bullish engulfing that's to the left of the chart. You can't see it. This little green dotted line is marking the middle of the previous day. So now, today, we're coming back into the middle of yesterday, and sure enough, boink, almost exactly hitting the right price. Richard, the first time we talked, which was give or take about a month or so ago, I showed you one of the charts that I was working with that particular day, and I believe your words were, you can't get better than that. That, I think, was verbatim what you told me.
Yeah, I can.
I turned around and said, I think I can, or yeah, I can. Yeah. How many days did it take me to send you a chart that looked better?
I think it was the next day.
Two days. I appreciate the comment. 2 days later, I emailed you a chart where we took 96%, I think, out of the range of that day trade.
Yeah.
We got in so close to the turning point, which I think was an ER3 trade, coming back into the middle of the previous day, that it was 2 or 3 cents off. Nothing at all. And it closed at the other end of the spectrum, meaning at its high or low, whichever was good, smack dab in the last 60 seconds. It was dynamite. So here we have the 1 minute trailing stop.
laying a lot on us here, but just remember, these are all recorded. They'll be available. We can go back and watch them 10 times if we have to.
I'd love that.
Our YouTube channel right here. If you're not subscribed to our YouTube channel, please join Foundation for the Study of Cycles YouTube channel.
In another way of speaking, slow down, Stan. I will.
Well, no, but
That's okay. That's okay.
Everybody to not panic that they can't follow everything that you're showing.
We know today, unlike the old days when you had no VCRs or anything like that, you had to watch the program real time and you just plain missed it. Too bad.
And I'm really excited to get to when you're showing the cycles.
Yes, I am.
With this system.
Coming up. I know we got 16 minutes left, so I'm conscious of that.
All right.
You don't have to hold up the card that says 5 minutes and then 4 minutes, like at the back of the lecture hall. They used to hold up a number. Now, we miss getting stopped out. The market begins to run away in our favor. We finally get out a few days after the entry. Good trade. The October lows. Some of your previous speakers have mentioned this. I'm going to show you in a slightly different way and a specific, exact, unambiguous way to trade it. Not that the damn market starts going up just before Christmas and it goes up in the early part of January. That's not much help at all, if you ask me. I'm going to tell you the date and the time of day.
You're a little bit, very attentive to the markets, maybe more so than most.
I grew up in the damn thing. So being a broker for 35 years, I kind of had to sit next to a quote machine constantly. Historically, in or close to October, the stock indexes frequently make a bottom and a nice rally. This is the October. I'm going to talk about the Santa Claus rally as quickly as I can. We see the market typically bottom out during October and maybe late September, maybe early November, but usually October. Next chart, let's just get to it. I'm going back 23 years. Every vertical dashed blue line is in October of each year.
Love it.
The window of opportunity is the little green dots at the bottom of the charting area.
I thought that was Mickey Mouse.
Yeah, I know. They got little faces, but that's because they got little hollow spots in the dots.
All right.
But they're kind of cute anyway.
Yeah.
Now we pick up a low exactly to the week. This is a weekly chart. Nice. So you don't know what day of the week, but it's that week.
Yep.
We're a little bit early, 1 week early. Now you may have a cycle low, an October low, any cycle low in a bear market. Typically that's not going to do very good if it does any good at all, because the trend is your friend and you're trying to buy in a bear market.
Right.
Okay, so take into consideration the intermediate to longer term trend when these things develop.
But this is pretty amazing. I mean, look.
Oh, it is. Absolutely it is.
Are caught by this.
I believe it's 61% on the money as far as the statistics that I came up with.
Wow.
So you can just scan this at your leisure and see how these things develop over time. 2014.
Software to detect this.
Pardon me?
You don't need any fancy software to detect this.
No, you don't. Not at all. No. Some of them are just exactly on the week, meaning the middle week of October. But as long as it's in that woo, 2 weeks early, 2 weeks late, and you have the tools to discern that today's the day or this week was the week, and you have some patience, not too much, and you get in, you should be all right. And that's a very vague type of statement. Next chart.
You should be.
Here are some recent examples with the Ehrlich reversal being used to have an automatic entry. October of 2010. I'm not that old. So you buy it, our trailing stop in yellow comes up, you're out a few months later. Darn good trade. Took most of the up move for the year out of the market.
Great trade.
Next year, not so good. Losing trade. A red line denotes a loser. Bad news. Next year, pretty much a whopper. Remember, the yellow line is adjustable for your tolerance of risk. You can make it tighter, you can make it looser, and it will still do the job. Do you want to buy a car with a big engine or a little engine and go fast or go slow, but you're still moving? You still got a car.
Nice.
The next one was very adequate and actually lasted the year. Next one, oops. But I want to point something out about this oops. All the way up until late summer, it was profitable. And it's only because of our ER trailing stop getting hit and the very bad fill in the next week that this chart shows you an exit that's really kind of inappropriate. That line should be getting out where the yellow is.
That does happen.
Yeah, but TradeStation has a bad habit of entering the trade on the opening of the next bar. So over the weekend, this dropped like a rock. Okay.
Okay.
Now, the next year, a small losing trade. The next year, a whopper, the big one for this decade plus. And you could have added another October low on top of the one you had if you wish to double your position, because the first one would have financed it. And then you have a losing year and then a good trade there. Next, the Santa Claus rally. Here is some detail not many people have heard of. So this is new. 1, 2, 3 business days, trading days before Christmas. You buy a third, then a third, then a third of your total position, S&P, DIA, stock that follows the overall market on the average, QQQs, I don't care, one of the major indexes. One of them will be better than the other each year. We don't know in a particular year, this coming year, which one's going to make the most. You buy 1/3 the first day, 1/3 the second day, 1/3 the next day, but I'm going to get to this in a few minutes. You hold the positions. This is the bad part. There's no money management with this. This is crazy. You have to get out a certain date, no matter what kind of a profit or loss you have. I don't like that a damn bit. I do not subscribe to this. I would absolutely use unequivocally some sort of money management technique, but this is the Santa Claus rally. Okay. Some years it starts out pretty bad and all of a sudden recovers. I do remember when Greenspan, I think it was, said on New Year's Day, gee, I think I'll lower interest rates. And the market that morning gapped up a tremendous amount and turned a Santa Claus rally loser into a whoopee. Big trade. Now,
Santa Claus, Greenspan.
Yeah, he was Santa Claus that year for sure. If you were in the Santa Claus rally trade, January, the first 3 days, the first trading day, you get out of 1/3, and I'll tell you when. The second day, you get out of your second third, and the third day of the year, you get out of your last part. But I wouldn't do that. I would use the STS trailing stop. That would allow you to make more if there is more move up during the next few hours, during the next few days, and maybe even longer than that. Here we go. This is last year. We bought it near the close of business 3 days, and that's 5 minutes before the close. California time, 12:55 p.m., 5 minutes before the close, on 3 days before Christmas. I guess the 22nd of December. The 23rd, we bought it at the same time, just before the close. Now, these fills don't look particularly good. Totally agree with that. That's not particularly cheap. Or I meant, yeah, it's cheap. Yeah, that's what we want. But not the low of the day. That would have been nicer. And this fill is actually kind of close to the high. We're making money. We're making money. Uh-oh. Santa Claus has left the building and dropped down like crazy. We're at a loss. And then on December 31st, it starts to turn up. We're back in the black. These lines are green again, real time. We're making a lot of money. And then it turns back. And then on that day, we get out at, what was it? I think it was 10:55 a.m. We offset the trade. On the second trading day of January, 10:55 a.m., we get out of the trade. That's pretty good. That was the high of the day almost. And this is kind of the middle of the day, 10:55, we're out. All 3 trades made money. Watch this 1 year earlier. This was, and we've talked about it before, December of 2018. The market crashed into Christmas.
Mhm.
Santa Claus's sleigh got a flat tire and oops, down the chimney it was going.
Mhm.
Luckily, there was a car repair shop in that house and they fixed it. And the day after Christmas, it zoomed straight up.
Mhm.
So we're buying, losing money on the first trade, buying, losing money on the first two trades. Oh man, I don't want to buy it again. I'm losing money on my first two trades, and tomorrow's Christmas. I'm losing all the presents I've got under the tree. Luckily, I've got the receipts so I can get my money back. Anyway, it takes off like a bat out of a hole, and it just goes straight up for actually months, a few months. But we're getting out 10:55 on the first trading day of January, same time the next day, and almost at the high of the day, 2 out of 3 days.
Wow.
And all 3 trades made money.
Why
Next.
5 a.m.?
That's the optimization. I don't know. The hell if I know. How would I know?
All right.
The computer told me so. We optimized entry and exit timing for 20 plus years, and that's what it came up. By the way, if you went back 2 or 3 years earlier, the time of day would have changed. The basic rule here is 3 days before Christmas, try your best to get in cheap. That's about it. The first 3 days of
average over the first 3 days.
Yeah, you're averaging in. Absolutely.
Yeah.
And you're averaging out the first 3 trading days of January, period.
Love it.
Okay. Now, 52-day cycle. These are cycle lows. We looked at one chart that showed you this earlier. We're going to go into some more detail. The anchor day, I got my cycle finder out. There was a lot of dust on it. I haven't used it for decades, and put it on December 26th of 2018 and started measuring. Oh my God. We had one heck of a day on that date. Normally I get between 5 and 15 signals a day. I had 288 buy signals on December 26th. That was screaming bottom.
Nice.
No guarantees, but it worked.
Yep.
Past tense. Here we go. December 26th in detail. 52-day cycle low. And now I'm showing you the cycle low before that during a bear move. That's the October low, by the way. Smack dab in October. It didn't do much. I mean, it went up for 5 days. I can't brag about that. It's enough to make a little bit of money, but certainly not what you want.
Right.
By the end of October, it was well in the new low ground, sideways for a month or so. And then December was point blank crash. Started like November 30th. All the way to the middle of Christmas was a holiday. Day after Christmas, green like crazy. And Richard, it came down into the middle of the range of December 26th, the next day. So we have an ER1 entry and we have an ER3 entry the next day. It never saw the bottom of the well again, straight up, like a rocket.
Yep.
And this actually kept on going and going and going. 52 days later, right barely in the woo, we had a low, drop down, and guess what? There was a sell signal only a week earlier. Came down, cycle low, a little earlier than you would have liked. Unfortunately, there was no buy signal during the woo. But it worked, just no signal. And you could have used other techniques to get in if you used a very short-term moving average or something like that. There's a whole mess of things you could have used. Next chart. December 26th on the left, 2018. There's the detail I just showed you a moment ago, just on the left of the woo. The next cycle low is a little to the right of the woo. The next cycle low, I have a signal, green. Up it goes, and I'll show you the signals in a minute in the trades. The next cycle low was not particularly profound. There's no way I would have said this is a cycle low. It's the right time, but there's not the right price action. It just kept drifting higher. There was no downside movement. Next cycle low here at the beginning of this year, minor downside correction a few days early. And then COVID hit. Crash to March 23rd, the low day. A lot of people say the low day is the closing low price. I disagree. The low day is the day that the lowest price of the move hit. Not necessarily, it could be the lowest closing price. They could be the same date.
Are these calendar days or trading days?
These are trading days.
Trading days.
Right. If there's a holiday, there's no blank space showing. So every trading day is right next to each other. I kind of like that. It's better for the techniques that I use. You can
that March bottom hit on that cycle.
Pardon me?
That's amazing that March bottom 2020 hit.
I know. I love it. That's why I'm showing it to you today with 4 minutes to go. Here we go. Cycle low just a couple of weeks ago. I think I'm going to zoom in. Oh, I'm going to show you. Yeah. Time for a couple of symbol requests. Let me see that I didn't skip a chart here real quick. Okay. If we have time from the audience, I will take a symbol request and go to my trade station and real time, real charts, put in the symbol. This is the Santa Claus rally, the chart I just copied for the show. So does somebody have a symbol?
Nice.
This is risky business.
Yeah.
Risky business.
Might need a minute to.
Yeah, don't take more than 30 seconds.
There's a slight delay on our live feed, so it takes a minute to catch up sometimes.
Absolutely.
So, but
here's, by the way, we got one signal today. This is a signal today. A bullish engulfing in CE, which is Celanese Corporation. So you see that we had a trade way over here in the top right. I'm waiting for you to tell me what symbol. And let's see here. Yep, there's the trade today in the top right. And tomorrow we set up an ER3 potential for the next 3 days. But our system turned the green.
How about Bitcoin?
Okay, fine. What is it? BTC. BTC.
Well, I don't know what it is in TradeStation, actually.
BTC.
Other symbol requests, they're flying.
No data. I can't get it. BTC.
All right, let's look at Amazon.
Oh, okay. AMZ something.
AMZN.
AMZN. Okay. We had and I'll expand the daily chart out to the right a little bit because it is, 1 second, things are recalculating, a little squeezed, and I rescale. Good. All right, I got 3 losing trades here, unfortunately. Let me see if I can get a good one in here real quick. Well, okay, back here in September, we did have an outside down day, and we went short, and it rallied and got us stopped out. But we've had a few losing trades in this particular symbol lately. But one good thing about the daily is that it doesn't represent what we do perfectly in the 1 minute. We didn't lose that much money, and we sure as heck didn't stay with the trade that long. This is a daily crude represent. Oh, let me say something.
CLD.
No, this is actually BS. And I'm not going to say bull. I did, but you know what I meant. Hang on a second. You see this red engulfing? It went down for a day. That gave us plenty of opportunity for a profit the next day, period. Look at this bullish and bearish engulfing. It went down for 1, 2, 3 days significantly. On my 1 minute charts on the right, that was a profitable trade. No doubt about it. On this bearish engulfing, we also had a ER3 trade the next day because look, it rallied back into the middle of the range. Mm-hmm. But I'm not showing you that on the daily data because we don't use it for trading. Mm-hmm. We use the 1 minute chart for trading. So I apologize for this looking like 3 bad trades in a row. It wasn't. Give me another symbol.
GLD.
Let me do this. Studies, edit, and turn the damn thing off. I think that will do it. Very good. Now you see bearish engulfings and a down move of a day or two, and that means you made some money without the trade showing. And again and again. What was the next symbol, please?
GLD.
GLD, gold. 2 days ago, bearish engulfing. Did we come back up into the middle of the range of GLD? Let's take a close look here. The bottom two charts, and I'll blow this up full screen, shows that we did have a retracement and we went short. It was a day trade loss, but we also have a version that holds on to the trade overnight. So we are not stopped out. We're still short and hopeful that in the next day or two, it will turn profitable. The daily chart shows a bearish engulfing back here on April 16th. And it went down for 3 days. Pretty good. Pretty nice trade. I'm sliding to the left, looking for red and green. Richard, that's what I hope to find for you guys. Love it. That is one heck of a buying. The day the market double bottomed out. And for months, it did nothing but go up on the average. I had a sell signal here that lasted a few days. And depending upon how you handle a buy signal or a sell signal, you might have taken a profit when you get a sell signal. You might have stayed with the trade. It depends upon how you have the parameters, the inputs set. We have a couple of minutes after the hour at this point. I would like to mention the Ehrlich Cycle Finder is available on my brand new website 2 hours ago.
Yeah, that's under the
I'm not kidding you. I was literally on the phone trying to, with GoDaddy, trying to get it opened up. Yeah. And she tells me it might take 24 hours for some areas of the world to see the website, but ersignals.com is where you can find more literature on the Ehrlich reversal and the ability at the moment to buy the Ehrlich Cycle Finder. We will be marketing and making available the Ehrlich reversal soon.
Fantastic.
Thank you.
Well, let's stop sharing the screen, turn our cameras back on, and just wrap it up.
Okay. Cycles are great. They really give you a psychological edge to okay, turn my camera on, huh? Just a moment.
And stop the screen share.
Stop the screen sharing. There you go. Click and camera. There I go.
All right. Excellent.
There you go. So cycles really give you a psychological edge. It's when they don't work, nothing works all the time, that you have to have a plan in place. Ours would be the STS, the Smart Trailing Stop. We quickly lock in a profit. We don't wait around for very long to move that stop. And that is the edge. It's money management plus having a reasonably good trading system to cause you to get into your transactions. Cycles help a lot because they give you an edge. They wouldn't be called a cycle unless there's a tendency for the market to top out and bottom out approximately when it's supposed to.
Well, it was very striking to see, how simple your cycles work.
It is really.
Right? And obviously you've got the ability to take it to whatever level of complexity you could possibly want to.
I try to keep it simple. It's hard to do.
Yeah, but yet you've really supplemented the cycles work with a quite, advanced reversal strategy that has grown out of, your 50 years of market.
Wait. It's only 49 years. Come on.
49 years. Sorry. Perpetually 49 years.
Yeah. Don't make me older than I am.
So that's quite striking. And then how thorough you are in your systems, right?
Well, as we mentioned in earlier conversations, my dad was a lawyer, so there's a lot of exactness being in that occupation.
Yeah.
Plus the fact that I was a gymnast in college, and it's an exacting sport. You better hit it right or you don't succeed.
and quick.
And quick.
All right.
Routines last what? A few seconds, 30 seconds
Right.
or less.
Well, fantastic. Stan, thank you so much.
Richard, I want to say again, thank you very much for having me on. It's an honor to work with you and the other speakers that we've heard over the last week. I never thought I'd be part of a group this luminary-ish. I didn't know I glowed in the dark. So, so thank you again ever so much. Pardon me?
I said, just don't call us the Illuminati.
Illuminati. Something, oh, my partner said AMZX for symbol, but I don't have the time.
All right. No, that was great. That was fantastic. Thank you. And everybody, we are the Foundation for the Study of Cycles. We are studying cycles. Please go to cycles.org, cycles.org. Join us, become a member for just $99 a year. It's nothing. Make a donation even beyond that. I mean, you've gotten so far 8 absolute legends of the business packed into 1 week, all available to you on YouTube. This is literally, I mean, there's 250 years of or more of
249
experience. 249. And tomorrow we're going to be wrapping up this Financial Cycles Summit with Ray Tomes from the Cycles Research Institute, along with David Hickson from Sentient Trader, doing more on Hearst cycles. And then I will be bringing us over the finish line to wrap things up with a review of the whole week. And I think we've seen a lot of common threads, and there are a lot of pieces we could take immediately, and then also sharing with you about the future of the Foundation for the Study of Cycles. So thank you so much, everybody. And we'll see you again tomorrow. Good night.
Good night.
Bye, Stan.
Bye-bye. Thank you.